On behalf of our team at HBKS Wealth Advisors, I would like to welcome you to Top 10 Opportunities for Retirement Plan Sponsors in 2021 with HBKS Principal and National Practice Leader for Retirement Plan Services, Dean Piccirillo. Our session is scheduled for 60 minutes and is being recorded. Please note that all attendees are set up in listen-only mode. If you would like to submit a question to our panel, please use the question box in the GoToWebinar control bar. A copy of the presentation materials is available for download in the handout section of the GoToWebinar control bar. A recording of the webinar and a copy of the presentation materials will be sent to you after the session. We value your feedback. Please complete the survey at the end of the session to let us know how we did. If you'd like to receive a complimentary consultation from HBKS Retirement Plan Services, you can request one in the survey or by emailing us. For more information and insights, please visit our insights page at the hbkswealth.com/insights. At this time, I'll turn it over to Dean.
Thank you, Lori. As Lori mentioned, my name is Dean Piccirillo. I lead the firm's retirement plan services group on a national basis. We provide investment and other retirement plan related consulting to our clients on a national basis that are sponsoring qualified retirement plans. As Lori mentioned, we're going to be talking about some best practices for plan sponsors and what we feel are some of the top considerations for plan sponsors in 2021. But frankly, these are important considerations for really any year, and this being nearer the beginning of the calendar year, it's an appropriate time to consider these potential enhancements to your retirement plan. And there are several reasons why, as sponsors of qualified retirement plans like 401ks, 403bs, you should be paying attention and thinking about the opportunities that we're going to be discussing. Of course, the biggest reason is the reason that employers put retirement plans in place is to help their employees be successful in their future retirement. And all of the considerations that we're going to be discussing today will help improve plan performance, reduce expenses, and should result in higher account balances for your participants, which is why employers put benefit plans like this in place to help people be successful during retirement. The other big reason, though, for those of you that are plan sponsors that are able to act with authority and make decisions with respect to how retirement plans are managed, is all of you are fiduciaries. And a fiduciary is the highest standard of care under the law, and you are personally responsible to manage retirement plans in accordance with the regulations exclusively for the benefit of your participants. And along with responsibility comes liability, and the ERISA regulations specifically wrote into the law that liability be personal, and it pierces the corporate veil. So, and that was specifically written into ERISA regulations to get plan sponsors to pay attention to managing their retirement plan in accordance with the law. So entity structure, C corporations, S corps, LLCs, all the things that as consultants we work with our clients on to protect principals, owners, decision makers, corporate officers from personal liability doesn't really apply in the ERISA world. The corporate veil is pierced. So those are all reasons, good reasons. The first and most important, of course, having a good, well-run plan will help your employees, your participants be successful during retirement. But there are other important reasons, such as the fact that if you're a qualified retirement plan sponsor, you're a fiduciary. So very important to pay attention to these. So we're going to go through 10 considerations, the top 10 opportunities to improve your plan. Then we're going to touch briefly on a few things that have come out of some legislation, both the CARES Act and the Secure Act over the last 2 years that may be somewhat relevant currently. And then we're going to talk towards the end of our presentation about some things that we see coming down the pike from a regulatory standpoint that may impact retirement plan design for plan sponsors on a going forward basis. There's actually a Secure Act 2 that's being considered. And then we've also looked at the Biden-Harris platform, and we have some thoughts on some of the things that they're advocating for with respect to how retirement plans are administered that may impact those of us that consult with retirement plan sponsors like HBKS and folks like yourselves who are sponsoring qualified retirement plans. If there are any questions that certainly pose your questions through the chat function of the app as we're going through the presentation. I'll try to answer them as they come up. Any questions that we can't answer, we'll circulate a response via email. One of the first things that you should consider, though, is consider an open architecture platform. And by open architecture, what we mean is a record-keeping solution that gives you access to most publicly traded mutual funds. Now, there's several different service providers that you need to contract with to put a 401k in place, and the record keeper is the firm that gives you and your participants access to the marketplace. That's the firm that you work with to build your menu of core investment alternatives. That's the firm that gives you as a plan sponsor access, online access to plan level reporting. They're the ones that are maintaining the website for your participants. They generate quarterly statements. They essentially keep the books and records of the plan. They provide custody and trade execution services. And our strong preference as investment advisors, as consultants to qualified retirement plans, is to operate on an open architecture platform. And that basically means you have access to all publicly traded mutual funds and ETF, no load, to include no load and institutionally priced funds. You want to avoid those packages where you're restricted, where the fund menu is restricted. It's often a warning sign if you see a lot of mutual funds that have the same name as the record-keeping platform. And what that often indicates is that you are with what we call a pay-to-play provider. And you don't want to, as a plan sponsor who has an obligation to make sure that they have best-in-class investment options available to their participants, you don't want to be working with a record keeper whose investment menu consists of fund families that have paid to be there. You want to have access to the best domestic U.S. large cap stock fund, the best mid-sized company fund, the best international fund. And if you're working with this pay-to-play model, it's difficult to do so. So the service providers that we work with in the record-keeping world give us access to 15,000 or more publicly traded investments. Now, you're never going to make that many investment options available to your participants, but when you're building the menu, if you have access to all publicly traded investment options, you know that you're always going to have a very competitive mix of investment options for your participants. And if we need to replace that foreign large blend fund, we're going to go out and look at the 800 other foreign large blend funds that are publicly available and pick the one that we think is the best. We don't want to be looking at the 80 funds that have paid to be on that platform. So open architecture is a best practice for 401k providers for record-keeping solutions. The industry, moving on to our second best practice, the retirement plan industry is, and we'll see this when we talk about the current regulatory environment and the litigation environment right now in the retirement plan world. The industry, the regulators, and the plaintiffs' bar are obsessed with fees, and rightfully so. And the big reason that you want to pay attention to fees, and this kind of goes back to my introduction, is fees impact performance, and they ultimately impact a participant's ability to be successful during retirement. So the industry is obsessed with fees. The regulators are very concerned about fees. The vast majority of litigation, companies that are getting sued for not properly monitoring their retirement plan and managing it for the best interest of their participants, they're getting sued because of excessive fees that are being passed on to participants. Not as concerned about fees that you as a plan sponsor are paying, but if you're passing them on to record keeping, administrative fees, other consulting fees, if you're passing those fees on to your participants through the plan assets, it's being deducted and it impacts their returns, you need to be paying attention to them. There's no requirement of, there's no definition of what a reasonable fee is, but the regulation specifically references the fact that they should be reasonable. Now, we feel a best practice for determining whether or not fees are reasonable is to do a fee benchmarking study, okay? And I'm going to give you a sample of what that looks like now. And again, we're going to be kind of going through some greatest hits, if you will, best practices, and we're going to be moving fairly quickly. And the purpose of this is not to do a deep dive into any one of these 10 opportunities to improve your plan, but to bring some things up on your radar for you to start to think about and circle back to your advisors and perhaps challenge them about the advice that you're getting. So again, the industry, the regulators, the plaintiffs bar, very concerned about fees, because particularly those fees that are passed on to participants that impact their returns. And you have an obligation to make sure that they're reasonable. So this is not a suggestion. You have an obligation under the rules of ERISA, which govern how retirement plans are to be managed, to make sure that they are reasonable. So this is not like other areas of business where it's a good idea to make sure your fees are reasonable because that's going to improve profitability. You have an obligation to do this. So this is a sample from a fee benchmarking study using a tool that we use in our practice with our clients. And if we do, we do a lot of complementary consulting for existing HBK families, clients of Hillbarth of HBK, because again, we're part of the HBK family, this is a sample from a study that we did for an existing client of the accounting firm that was not yet working with HBKS. So this particular plan had almost 9 million in it, and our database, our fee benchmarking database, compares a plan based on assets and based on number of participants to a large basket of other plans of a similar size. And we're looking at the major categories of fees that plan sponsors are going to be paying: record keeping, advisor fees for investment consulting, investment management fees. These would be fees for the underlying mutual funds, and then also administrative fees, which get wrapped up here in this category. And this particular plan had, when we initially looked at it, total fees of about 1.5%. And that put them in the top 10% of the most expensive plans, comparing it to 700 and almost 750 other plans in the database with between $5 and $10 million. So that would tell you if you're in the top 10% and top 10% being the most expensive in this particular category, you've got some room for improvement. So this would be a tool where you could go back to your service providers and hopefully negotiate better fees on the plan. Now, if we were to do a benchmarking study and we found that you were in the 50th percentile or less, then that really then becomes support that you're meeting your obligation to make sure that the fees are reasonable, presuming that you remain comfortable with the services. So examining plan fees is important, and remember, you have an obligation to make sure that the fees are reasonable, And we think a best practice for doing so is to have a benchmarking study where you're actually doing a forensic review of all of your plan's various fees, and then you're comparing those to other plans of a similar size. And that will begin to give you a sense as to whether or not your fees are reasonable. This is something that we do for our existing clients, probably on average about once every 2 years. And then if we feel we need to go back out to the marketplace and do a request for proposal for a particular service, this is support for that effort. And then this also then becomes support for renegotiating your fees, if that makes sense. Now, there's two ways to do the benchmarking. You can compare it based on assets, and you can also compare those fees based on the number of participants. So this plan had 220 participants. There were 725 plans now in the database at the time we did this, was between 100 and 250 participants. So same total fees, still in the most expensive decile, in the top 10% of most expensive plans. Now, most record-keeping services are priced on a per participant basis, because that's what really drives costs for participants. So the bottom line is, no matter how you compare this plan, whether you compare it to other plans of a similar size based on assets, or you compare it to other plans of a similar size based on the number of participants, this is in one of the more expensive brackets. Again, I think the important thing is be aware that fees are important to pay attention to. You have an obligation to do so. A best practice is to connect with an advisor that can help you prepare a benchmarking study, and then that becomes an excellent tool that you can use to renegotiate fees, and it will also really help you determine whether or not going out to the market and considering other service providers really makes sense. So that's one of the big areas that plan sponsors have an obligation to monitor. The other one is monitoring plan investment options. So those designated investment alternatives, the core fund menu, the 12 to 15 or 20 investment options that you make available to your participants, this is another obligation that you have as a plan sponsor. You have to monitor them, and you have to make sure that they're pretty good. Now, if you look at the regulation, there's no definition of what a good large cap growth fund is or a good large cap value fund. But what they do talk a lot about in the regulation is this concept of procedural prudence. You have to have a prudent process that you use to select and monitor the investment options that you make available to your participants in the plan. And importantly, you have to document that you followed that prudent process, and that really becomes your best defense in the event that you're ever challenged about the quality of the investments that you have, the quality of the management, their performance. You have to have a prudent, defined process, and you have to be able to document that you followed it. Now, we think that a good best practice for this prudent process is to have an investment policy statement for your retirement plan. And the investment policy statement, I'm going to show you a sample from one page of an investment policy statement here in a moment. But the investment policy statement really defines how you're going to select and monitor the investment options. It's going to talk about roles and responsibilities, who does what, frequency of review for the investment options. And importantly, it's going to talk about the benchmarks that you're going to monitor these investment managers based on, the underlying funds. And then you actually have to do it, and you have to document that you've done so. Now, again, documentation is the key. You don't want to have a defined process and then not that's prudent and defensible, and then not be able to document that you've actually followed it. So this is just one page from an investment policy statement that we use in our practice with our clients. And here we're specifically talking about investment manager investment option selection criteria, the benchmarks that we're gonna look at. I'll just touch on a couple of them. You want to make sure that the manager that you're using is actually buying the securities that they state that they're going to buy based on the stated investment style of the fund. So we look and make sure that if the manager says they're buying large cap growth stocks, we actually look down at the underlying holdings of the fund and make sure that that's the case. We look at the performance of the fund, of course, and we're looking at that performance relative to peer group over a 1, 3, and 5 year period of time. And we like to see managers that are consistently in the top half in their peer group. We want the manager managing the fund to have at least a 3-year track record. We look at the assets under management, and we want at least $75 million in the fund invested, again based on the stated investment style of the fund. We look at the expense ratio. So the expense ratio of the fund itself, we compare that to that fund's peer group, and we don't want any funds that are in the most expensive quartile. So the purpose of this is not really an investment presentation. The point that I want to make here is you should have a prudent, defined process, and you should be able to document that you've followed it. And believe me, if a regulator comes in and it could be most likely it would be the Department of Labor, could also be the IRS. They're going to ask for all of the minutes of your investment committee meetings. This will be one of 100 things to ask for, but they're going to ask for all of the investment committee meeting minutes, and they're going to want to see documentation that you have established a prudent process and that you followed it. I've seen them go back and request these records for years. And again, if you're ever challenged by a participant, if they ever come to you and say, I don't have enough money to retire successfully, and I think it's because I had poor investments, then this becomes your documentation that you followed and maintained a prudent process. Okay, so this is output from our fiduciary monitoring tool. And again, this is not really an investment presentation. I don't want to get too lost in the weeds with respect to various mutual fund benchmarks, et cetera. It's not really the purpose. The point that I want to make is this tool ties out perfectly with the investment policy statement. So for example, we're comparing the fund's expense ratio. And you remember, we didn't want to see any funds that were in the most expensive quartile. And this fund actually is one of the least expensive funds in the category. The black diamond shows where the fund is relative to peer group. We also wanted to compare the performance of the fund over a 1, 3, and 5 year period of time. We state that we're going to do that in the investment policy statement. And here you can see where this black diamond is. This is the median. So this is the performance of the group, the median fund. And the black diamond shows where the fund lands relative to the peer group. So, and again, it did consistently well there. We looked at style consistency. We looked at composition of the portfolio. The fund's been around since 1994. It's got almost $3 billion in assets in it. The money manager tenure, almost 18 years. So the bottom line is we can go through each of the criteria that we detailed in the investment policy statement, and we can document that we've looked at it. And then those things get blended into an overall fiduciary score, which is top quartile for multiple time horizons. So if a participant ever challenges this plan sponsor about whether or not they were paying attention to the investment options in the plan, they can say, we have a very reasonable, defined, prudent process, which is detailed in our investment policy statement, and we can document quarter after quarter after quarter where we monitored these investment options and took action if they weren't meeting our requirements based on that investment policy statement. So again, two really key things that plan sponsors need to be able to, that are responsible for, and that they need to be able to document, number one, fees, you have an obligation to make sure that your fees are reasonable. And a best practice is to do a periodic benchmarking study and compare those fees to other plans of a similar size and retain that as part of your documentation that you should have as a fiduciary, the meeting minutes, et cetera. And then you have an obligation to make sure that your investment options are high quality. And again, procedural prudence is the key. You need to have a prudent, defined process. A great way to do that is through an investment policy statement, and then you should be able to document that you followed that investment policy statement. A couple of other things, another area where we see plan sponsors often run into challenges is tracking the timeliness of participant deferrals. Once you withhold money from an employee or a participant's pay, you're under the gun to get that deposited in the 401k trust account for that participant. And again, we have 150 clients, 401k clients, and 403b, let's say defined contribution plan clients that we consult with. And so periodically, at least a couple of times a year, with that many retirement plans that we consult with, our clients will go through a random DOL audit. And one of the things that they always request is payroll records, sometimes going back I've seen them go back 7 years and request payroll records. So they want to see when the money was withheld from the employee's pay. They're going to request records of your corporate checking account. So they're going to want to see when was it withheld, when did it come out of your corporate account. They're going to then request records of the 401k trust. And they're going to want to see when it was deposited and invested on behalf of the employee based on the employee's instructions. So they're going to follow the whole chain, and they're going to check dozens and dozens of transactions, and they're going to see how fast you were able to withhold the money, deposit it, and get it invested. And that really is the standard then that you're held to. So if you demonstrate that you have an ability to make a deposit after withholding the money from the participant after 3 days, then you're held to that standard going forward. And if it takes you 2 weeks or a month to make that deposit, you're on the hook for lost earnings. And it's not just the lost earnings, it's just even trying to calculate the lost earnings can be costly and time consuming. So if there's one area that tends to both trigger Department of Labor investigations and where plan sponsors get tripped up, it's in this area. And this is one area too that your participants will notice if their deposits are not, if their money's being withheld from their pay and they're not being deposited in a timely manner. This is something that they will notice, and we have seen in the past where they will pick up the phone and call the DOL, and that is something that triggers an audit. You won't always know why they come in, but this is one of the big reasons. So also something to just pay attention to and to make sure your payroll provider and your record keeper are working effectively together. Another opportunity is to periodically go through a plan design review. Again, we could do a whole webinar, seminar, maybe someday we will, not today, thankfully, on plan design opportunities. But this is just, again, something you can challenge your service providers on. There are opportunities for plan sponsors to enhance things like how they allocate their profit sharing contribution, as an example, that allows them to contribute perhaps more toward employees that might be on average older, or that might be in certain employment classifications. So again, just a good conversation to have with your service provider that's doing your plan document and your allocation, because again, there may be an opportunity to weight more of an employer contribution, such as a profit sharing contribution, to those that you really want to benefit the most from the retirement plan. And I'm going to show you an example. It's a rather dramatic example, but it'll give you a sense of some of the opportunities that are available. There's also a type of plan. It's called a cash balance retirement plan. And this is a type of plan that is sometimes paired with a 401k that, again, may also make sense if you really want to accelerate contributions, tax advantage contributions for the participants in the plan. Again, you could spend an hour just talking about cash balance plans. I just, for our purposes today, just want to bring it up on your radar. And I think it's a good thing to ask a consultant about. It's a hybrid plan, and it has characteristics of a defined contribution plan and a defined benefit plan, and allows you to really make some significant tax advantaged contributions. And I'm going to show you an example that sort of attempts to tie all this together in a professional services firm controlled by two partners, and in this case, both spouses work in the practice, and then they have about 20 support team members as well. And this is not an unusual type of practice that our firm consults with. This is going to look similar to a lot of medical practices with respect to total compensation, engineering firms, architectural practices, etc., where you've got a couple of principals who are very well compensated. You might have some other key staff members who are well compensated, and then you have a team of people that is providing support to those principals. So this looks a lot like the typical smaller medical practice, dental practice, engineering firm, architectural firm, law firm, etc. And the only thing I'm trying to illustrate here is, again, you could spend an hour just talking about these techniques, but I want to illustrate just how the benefit of reconsidering design, what that can mean in certain situations. Now, of course, not every company can afford to make these contributions, but for those that can, we can sometimes achieve some very dramatic benefits. So we've got a few things going on here. We of course have owner deferrals, and this was prepared about a year ago. And at the time, the maximum salary deferral contribution was $19,000, so we're illustrating that. And then we have the ability to do a profit sharing contribution. And you can see, the combined profit sharing contribution for the two owners was $37,000, and then we're assuming that they're making the maximum salary deferral contribution as well. And then the last column is this cash balance contribution. And you can see for owner one, the principal, the founder of the practice, in the cash balance plan, it sounds incredible, but we were able to show them how they could contribute about $213,000. So now this plan still is going to then require some contributions for the rest of the team, and we have to do a 2% cash balance contribution for everybody else. And then we have to do a 6.8% profit sharing contribution for everybody else. So the participants are going to get about 9% of their pay. So it's a very generous plan for the team as well. But it works particularly well for the more highly compensated principals in this case. Of the total employer contributions going into the plan, $470,000. So this is the number that is deductible at the company level at potentially 37%. So your tax savings is, you're going to apply 0.37 to this number, and that's your tax savings. Okay, so it's more than $150,000 in tax savings. The cost for the staff is $84,000. So it's a very good benefit for the participants. It's approaching 9% in employer contributions, but all of those contributions to the participants are paid for by the tax deduction, and then there's additional monies that are being saved in the way of income tax savings that go back to the partners as well. So they're actually coming out ahead to the tune of $70,000 or $80,000 in tax savings after making a significant contribution for themselves and making a very generous contribution for their team at 8%. So again, covered a lot of ground there, and there are a lot of nuances here that we don't really have time to discuss. Again, the point I want to make here is go back and ask your service providers, your third-party administrator, your other consultants, am I taking advantage of everything that's available to me from a plan design standpoint to maximize tax advantage contributions for the most productive people in my firm? And oftentimes there are opportunities to do things like this. This is a rather extreme example, but oftentimes there are intermediate steps that you can take that will allow you to significantly enhance the plan design and take better advantage of this tax planning tool. Consider challenging your investment consultants and other advisors on their fiduciary responsibility that they are accepting. I've already talked about the fact in the introduction that as a plan sponsor, you have a fiduciary responsibility to monitor the plan's expenses, to monitor investment options based on a prudent fiduciary standard of care. Well, if you're paying an investment advisor a fee, they may be fiduciaries as well if they're giving you investment advice. And there's two different types of fiduciary responsibility that a firm like ours will acknowledge and accept. And actually, as service providers to a retirement plan, we are required to disclose this to our clients in writing, whether or not we are a fiduciary, and whether or not we are a non-discretionary fiduciary, or whether we are acting with discretion as a discretionary investment manager. And I'm going to explain the difference. And again, I think the key is you want to go back to your advisors and ask them, A, do you acknowledge your fiduciary responsibility? And B, are you acting as a non-discretionary advisor, or are you acting as a discretionary investment manager? So what ERISA 321 is, that's this non-discretionary investment manager. And by non-discretionary, what we mean is just what it sounds like. We are giving you, if we're acting in this capacity, investment advice, and you're saying yes or no. And we are essentially sitting on the same side of the table as you, from a fiduciary liability standpoint. So we bear the same level of responsibility, but we're helping you manage that fiduciary process. So we're drafting the investment policy statement, we're providing you with consulting, we're advising you when to place a fund on the watch list, when to remove it from watch, when to consider replacing it, et cetera. And you are saying yes or no. And we are effectively co-fiduciaries in the plan and bear the same level of responsibility that you do. And by providing that prudent process, and by accepting and acknowledging our fiduciary responsibility, we go a long way to mitigate the responsibility of our clients. Now, firms like ours, not all of them are willing to do this. We happen to be. We're comfortable acting as either a 321 non-discretionary or a 338 discretionary investment manager. Firms like ours have the ability also to be a discretionary investment manager. And you want to ask your advisor, ask your broker, your agent, your investment consultant, A, do you consider yourself a fiduciary, and B, are you discretionary or non-discretionary? And there's a big difference. If we are acting as a discretionary investment manager under ERISA 338, that basically means we're no longer giving you a recommendation and you're saying yes or no. We are actually managing the plan on your behalf. So if we feel that XYZ mutual fund should be replaced with ABC mutual fund, we're just going to go ahead and do that. We're not going to ask you if you agree with that decision. You're essentially delegating the authority to us for investment-related decisions. And by doing so, you are relieving yourself of the liability brought about by investment management decisions. So it's very different. Remember, here under 321, we are a co-fiduciary. So we have the same responsibility as you. I don't want to minimize it. It is important, and we're providing this fiduciary process, and we're somebody else with professional liability insurance that's going to be sitting right next to you at the deposition if something goes wrong. I don't want to minimize that. It's important. But as a 338 advisor, we relieve our clients of responsibility related to investment decisions. So you're setting broad guidelines, you're approving the investment policy statement, and then we're managing the plan on a discretionary basis. At our firm, we're comfortable acting in either capacity. Many firms are not comfortable, being a fiduciary. If you read the service agreements, they're actually delegating all of that responsibility to you. Some firms are comfortable being a 321, which is co-fiduciary, but not a 338. So it's just important for you to know what capacity is your advisor serving. Now, again, if we're a 321 or 338, discretionary or non-discretionary, that fiduciary relief only applies to investment-related decisions for your retirement plan. We're not approving loans, we're not approving hardship withdrawals, we're not signing off on profit-sharing allocations, all of those administrative functions that are performed by a third-party administrator. Now, there are notice requirements is another one. There are third-party administrators that are also willing to serve as fiduciary advisors. It's called 316 administrative services. And in this case, they are actually taking responsibility for all that other stuff. So they're taking responsibility for getting notifications out. They're taking responsibility for approving the profit sharing allocation. They're taking responsibility for approving loans, etc. All of those things they're personally taking responsibility for. So these are a bit more unusual. Typical third-party administrator does not do this, but there are some out there that do. So it is possible to work with a 338 investment consultant and work with a 316 administrative service provider and relieve yourself of a material amount of fiduciary responsibility and liability. But I think really the key point that I want to make there is you want to make sure that you understand, does your advisor acknowledge their fiduciary responsibility, and are they acting in a discretionary capacity, or are they acting in a non-discretionary capacity? This sounds like kind of a simple one, but it's something that we see missed quite often. And by the way, this gets reported to the regulators on the tax return for the retirement plan, the 5500. Retirement plans are required to make sure that they have an Erisa bond. And the bond really protects the employee benefit plan from the risk of fraud or dishonesty on the part of persons who handle the funds. So controller types, payroll types, etc., who are handling deposits into the retirement plan. And you are required to have a bond. It's not optional, and the bond is required to be at least 10% of the funds that are handled by the plan. And if you don't have an Erisa bond, it's a violation of the law. It's unlawful not to have one. And you're actually reporting the fact that you don't have a bond and or that you don't have an adequate bond on the tax return, and this is publicly available information. So I can go, and our firm subscribes to the National 5500 database. There's 722,000 defined contribution plans in the country. They all file a 5500. We have the ability to pull down from that database, and one of the things that we can see is, do you have an Erisa bond, and do you have an adequate Erisa bond? It's publicly available information. So you could reach out to me, for example, after this presentation. I can look at your 2019 5500, and I can tell you if your third-party administrator was reporting whether or not you had an adequate Erisa bond. And everybody has access to this information. It's publicly available. And anything that goes on that 5500, the number of participants, your contributions, plan balances, who the fiduciaries are, it's all publicly available. And there are database providers that consolidate that information so that service providers like myself, et cetera, can obtain reporting. So again, I just want to emphasize that you need to have one. and it needs to be adequate, and it can be a trigger for a Department of Labor investigation if the Erisa bond is not adequate. It's generally a warning sign for other issues. This is a big one as well. Number 9, consider, and this is another thing that is publicly available information if you're not doing this. Consider complying with Regulation 404C. And Regulation 404C is a voluntary regulation, so you don't have to comply with it as a plan sponsor. However, if you do voluntarily comply with Regulation 404C, you gain protection from liability brought about by poor investment decisions that your participants make. So you might be thinking, what are you talking about, Dean? I have a defined contribution plan. I give my employees the ability to allocate their account any way they want. How can I be responsible if they make a dumb decision? Believe it or not, and this sounds crazy, and to this day, after 30 years of doing this regulations, it still sounds crazy to me. But believe it or not, you are responsible for every decision that your employees make, even if it's a participant-directed plan, if you have not complied with Regulation 404C. And again, this is also something that's reported right under 5500. So I can pull your 5500 from the DOL database, and I can tell you whether or not you're indicating if you've complied with this regulation or not. And a good example would be the participant who, rather than having a properly diversified portfolio across multiple investment categories, they decide that they're going to roll the dice and they're going to put all their money in diversified emerging markets. Stocks in companies based in foreign countries where the economies are still emerging. Classic China, Brazil, Russia. Generally a very conservative asset class, not the kind of place you want to put all of your retirement dollars. Maybe you want to put 5% there, typically. If that fund loses half its value in a year, and the plan has not complied with 404C, the participant is not responsible for that dumb decision. You are as the plan sponsor. So again, there are some nuances here with respect to how you comply. It has a lot to do with disclosures, the types of investment options you make available to your participant, et cetera. It's not, frankly, hard to comply. But you should know whether or not you are, because if you have 200 participants and you're not in compliance with 404C, then you're responsible for every decision that 200 participants make. Again, it sounds insane, it sounds unfair to me, and to this day it still does. But that's how it works. So plan sponsors are responsible for the decisions that their employees make if they're not complying with 404C. And there are some things that you have to do, none of which are that hard. You have to make sure that your participants have an ability to adequately diversify their account. You have to have at least 3 different investment alternatives, as an example, with different investment objectives. You have to provide certain disclosures with respect to the designated investment alternatives and the associated fees, et cetera. You have to let the plan and participants in the world know that you intend to comply with 404C by doing things like indicating that you are on the 5500, putting that in your summary plan description, et cetera. Frankly, it's not hard stuff. And there's no penalty if you try to comply and fail to comply. It's not like you're penalized if you try to comply and you miss something. But if you don't comply, then you have no opportunity to gain that protection from liability brought about by poor investment decisions made by your participants. And again, we're kind of doing a whirlwind tour here of retirement plan best practices. I think the key here that I want to impart with respect to this reg is you should know whether or not you're attempting to comply with it, and you should go back and challenge your service providers about helping you get in compliance with 404C, because I'd say for the most part, you don't want to be responsible for every decision that every employee makes. And here's another one that we see. This is another thing that I can tell just by pulling a publicly available 5500 that's available to anybody to look at, whether or not you have a QDIA or a qualified default investment alternative. And the purpose of a QDIA is for participants who don't make an investment election, and this happens all the time. where you make a profit sharing contribution and you have a participant that hasn't elected to put their own money in the plan, they're going to get a deposit. Well, if you have a QDIA, you gain protection from liability for having made a decision for the employee. And that's how it's viewed under the law. So if you make a profit sharing contribution, you give an employee 3%, and they never proactively told the plan how they wanted the money to be invested, and it goes into a cash account, you could be responsible for lost earnings over the next 10 years for having essentially made a decision for the employee. So if you select a cash investment, and that money sits in cash for the next 20 years, where it would have been better off in a balanced fund, you're responsible for the lost earnings because it wasn't a QDIA. If you have a qualified default investment alternative, which requires disclosing to your participants that it exists, and a QDIA is the types of investments that meet this QDIA requirement are defined. Things like a balanced fund, a model portfolio, or a target date fund all meet the requirements of a QDIA, but the key is notice. You have to give notification that if if a deposit is made and the employee hasn't made a decision, it's going to get invested in this qualified default investment alternative. It's another area where if you don't have one, it's typically a warning sign that something else is being missed. And again, all that information is publicly available. So those are the top 10 things that we see in our practice. And again, we see dozens and dozens of, because our firm has a national presence. Our colleagues at HBK have tens of thousands of corporate clients. So myself and my team in the retirement plan practices area looks at dozens and dozens of retirement plans and does these types of reviews on a monthly basis. And these are some of the most common challenges that we see and opportunities for improvement. Okay, so we've got about 8 minutes left in our scheduled time, so I'm going to kind of move through the rest of this fairly quickly. There are some things that I think are more important to emphasize than others. The CARES Act was passed in the spring of last year as a result of the coronavirus pandemic. And there's a couple of things that we're now circling back to as retirement plan consultants that are going to be relevant. First of all, required minimum distributions are back. So there will be, unless this is changed again, but as of now, there will be RMDs required in 2021, and they're going to be based on the 12/31 of 20 balances. Also, and this is something you're going to want to connect with your administrative firm on, if your plan sponsors, you're probably already aware of the fact that participants, as a result of the CARES Act, were able to suspend loan payments and extend the term of the loan beyond the normal 5-year max. Well, now all of those loans are getting, but interest was still accruing, even though they were able to suspend payments. So now all of those loans have to be re-amortized and payments should be restarting based on that new amortization schedule. Again, kind of just something that you want to be aware of and perhaps consider reconnecting if you have participants that chose that option, something you want to connect with your record keeping and administrative firm on. The Secure Act was passed a couple of years ago, and it came with a lot of enhancements to the retirement plan marketplace on a national basis. And some things that we're now seeing our clients take advantage of. There is an expanded tax credit that's available for new plans. So if you've established a new plan in the last 3 years, you can get a credit for up to $5,000 to offset your administrative fees. There's a comparatively small, and I think this is really more indicative of where the regulators and where the legislators are going with retirement plan rules and regulations, there's a comparatively small tax credit for auto-enrolling participants in your retirement plan. So everything that I read is moving towards automatically enrolling participants and providing incentives, in some cases requirements, for plan sponsors to auto-enroll participants in retirement plans. Obviously, we've got tens of thousands of baby boomers a day now transitioning from work to retirement. You've all probably heard about the stress on the Social Security system and the future of Social Security. Consequently, Congress and national leadership is looking for ways to incentivize and or require people to save more money to take stress off those public benefit programs. And as a result of that, we're already hearing rumblings, and this is very recent. This is from October of 2020, so last year, in the midst of the pandemic and everything else that's going on. They're talking about Secure Act 2.0. So they're sponsored by two congressmen, and by the way, there is huge bipartisan support for these enhancements. The Secure Act passed with overwhelming support from both parties. I think there was 410 votes on the House of Representatives approving the Secure Act. So you can expect these things that we're talking about. None of this is law currently. They're all being proposed, but I think you can absolutely expect, despite everything else that's going on, to see more changes similar to what we're going to talk about here coming down the pike. Again, additional incentives and or requirements to automatically enroll participants in the plan, and in some cases, auto-escalate those contributions. So we're going to automatically enroll you at 3%, and then we're going to automatically increase your contributions every year until you get to 10%. Additional tax credits for new retirement plans. They're actually looking at pushing back again the year where you're required to take your required minimum distribution. It went with the original Secure Act from 70 to 72. They're looking at pushing that to 75. So again, looking at incentives and or requirements to increase contributions on an automatic basis and automatically enroll people. And then, of course, when we drill down beyond the the Secure Act and look at some of the things that the Biden-Harris administration had on their platform, there may be some other interesting things coming. I think the thing that really jumped out at me was replacement of pre-tax salary deferral contributions. This would be a dramatic change, but this is something that Biden is in favor of. With a refundable tax credit for contributing to a retirement plan. And the percentage that they're considering currently is 26%. So right now, if you make a pre-tax contribution, not a Roth contribution, but if you make a pre-tax contribution to a retirement plan, it reduces your taxable income dollar for dollar. So if you're in the 37% tax bracket, so your employees and participants that are high earners, they're saving 37 cents on every dollar that goes into that retirement plan. Whereas, so if somebody puts in $10,000, they're going to save $3,700. This would provide in my example, if you contributed $10,000, it would provide a $2,600 tax credit, and as in the form of a matching contribution. And the thought is that this would be deposited right into the retirement plan account, as opposed to reducing taxable income. So this would work. This would be very attractive if you're in the 15% tax bracket, because instead of saving, again, kind of just keeping the numbers consistent, instead of saving $1,500 now on that $10,000 contribution, you're going to get $2,600 and you're going to get it deposited into your account. So it's going to work less well for folks in higher tax brackets. It's going to be more effective if you're in a 10 or a 15% marginal tax bracket, as an example. So just a whole different scheme with respect to the tax benefits of making a contribution. And this then may also lead more people to consider making an after-tax Roth contribution as well. And then another thing that the Biden-Harris administration is an advocate of is this concept of the automatic 401k. Whereas meaning if you don't have a retirement plan, you're still going to be required to withhold money from participants' pay and drop them into something like an individual retirement account. So again, it's an incentive to have a retirement plan in place, and if you don't, you're still going to have to do some administration and automatically contribute money from somebody's compensation to a retirement plan. So the whole industry is moving toward automation, automatic enrollment, automatic increase, et cetera, because there's a huge and very real concern about the future viability of the retirement system in the country. So the more we can incentivize or require people to make contributions, the better off. Okay, it's right at 4 o'clock, so I'm just going to take 5 minutes and hit a couple of highlights, and then I'll be all done. I want to talk a little bit about the DOL enforcement actions. As I mentioned, there's about 720 retirement plans. They are regulated and administered by the Employee Benefits Security Administration, which is a department of the Department of Labor. And if they do an audit, they actually refer to it as an investigation. And this is a summary through 2020 of the amount of money that they have recovered for participants from plan sponsors. It's increased dramatically since 2017. So they're getting better every year at their job. And of course, the dollars that they're recovering on behalf of these participants is of course coming from companies who have mismanaged their plans. The most common violations, these are all going to sound familiar: imprudent investments, improper payment of expenses and compensation to fiduciaries, not maintaining an Erisa Bond, late deposits, all included in our top 10 opportunities for improvement. And if you don't file a 5500 or you file it late, that's another warning sign. And then the last thing I'm going to talk about, and then I'm all done, is kind of the state of play from a litigation standpoint, because as plan sponsors, you have to be concerned about regulators like the Department of Labor, the IRS, and you also have to be, frankly, concerned about the plaintiff's bar and getting sued by your employees. And this is an area of opportunity for the plaintiff's bar, because if you think about it, you're dealing with companies who have money, who have a fiduciary responsibility, and whose officers are personally responsible and liable to manage the plan in accordance with the law. I mean, if you're a plaintiff's lawyer, this is a good area of law to focus on. And for plans that are mismanaged, you're providing a tremendous service to those participants. The number of cases in this area increased by 5 times just between 2019 and 2020. And some of that might be because of the global pandemic and the market downturn. People are just naturally paying closer attention to their participant balances. And here's a couple of examples. Now these are big companies, but we're seeing these cases go down market to smaller plans. This one kind of amazed me. Fidelity Investments. Yeah, that Fidelity Investments, the one with $2 trillion in retirement plan assets, they just settled a $30 million settlement for their own 401k. So this is for employees of Fidelity. I mean, can you imagine being a 401k administrative firm and having to settle for mismanaging your own plan for your own employees? And one of the things that they agreed to as part of the settlement, now this is Fidelity, $2 trillion in retirement plan assets alone, like the biggest in the world. They agreed to appoint 1 or more plan fiduciaries who would be responsible for monitoring expenses. Really, Fidelity? It's just amazing. And Mercedes-Benz US just got sued in January, and they're getting sued for not monitoring costs, excessive plan fees, not monitoring the investment options. It's all the stuff that we're talking about. And again, a lot of these fees, the initial round of litigation over the last several years started with bigger plans, But again, the plaintiff's bar is going down market and focusing on smaller plans too, with less than 100 employees, less than 1,000 employees and less than 100 million in assets. And again, they're focusing on all the same things, not having the lowest cost shares, not considering index funds where appropriate, having funds that have the same name as the record keeper. All warning signs and all things that are being focused on by plaintiffs' law firms. And again, what they're doing, they have access to the same information that all of us have access to. They're pulling the 5500s right out of the publicly available databases, and sometimes adding companies to lawsuits just based on things that they can see in the company's tax return. So that is, and it's 5 after. I went over 5 minutes, which is not bad for me, as my colleagues will confirm. I'll tell you a little bit about HBKS. We're part of the HBK family of companies. We've got approaching 100 team members on a national basis. We manage $4.3 billion for our clients. We have offices, multiple offices in all the same market areas that our colleagues at HBK have a presence: Ohio, Pennsylvania, Florida, and New York. Our retirement plan services group is national. I chair that niche on a national basis, but we have full-time staffing that covers all of the market areas that are referenced here in New York, New Jersey, Pennsylvania, Ohio, and Florida. The Wall Street Journal just ranked us as the 67th largest independently owned registered investment advisor in the country. And again, we're part of the HBK family of companies, which is one of the largest business accounting and business consulting firms in the country, founded in 1949. So we've been around a while. We're not going anywhere. And unlike a lot of the firms that we compete against on a national basis, those of us that work in the retirement plan space are specialists, and we work full-time consulting with qualified retirement plans. And here's a few facts about HBK. So that is a very quick tour of some of the things that you should consider following up on as a plan sponsor to improve your plan and make your employees more successful, and also mitigate your personal responsibility and liability. And as Lori mentioned in the introduction, you will be receiving a survey immediately after the presentation. We, of course, appreciate your feedback, what you like, what you didn't like, what you thought we could improve. If you would like a complimentary consultation with somebody from our team in the retirement services group to review your plan, or there's anything you want to hash out or discuss, you can let us know as part of that survey. And then within the next 24 hours, you'll receive an email from our team that'll include the handout, a handout of the PowerPoint slides that I've just reviewed, along with a link to the recorded presentation. And again, that would be another opportunity if you wanted to consult with us, you could do so when you receive that email. If not, hopefully we've given you some good information that you can use to go back and focus on opportunities to improve your plan and reach out and challenge your service providers as well. So, thank you.